In this video, we get the rare opportunity to dive into the mind of an investing legend, Peter Lynch. He is widely known for his success with the Fidelity Magellan Fund, where he built a reputation as one of the most remarkable investors of all time. Over 13 years, he consistently outperformed the stock market, delivering an astounding average return of 29% per year. Under his leadership, the fund grew from a modest $20 million to an incredible $40 billion. Then, at the young age of 46, he decided to step away from the game and retire early. But despite his departure, his wisdom remains invaluable, especially in today's volatile market. With the economy facing uncertainty, Lynch's strategies for making millions during a stock market downturn are more relevant than ever. If you're looking for practical guidance on how to navigate market fluctuations, you won't want to miss this. But before we continue, do us a favor. Leave a like and subscribe to our channel. It helps a lot, and we appreciate the support. Now, let's begin. Think about this. If you don't fully understand the company you're investing in, and you're only buying stocks because their price has dropped from $26 to $16, then to $10, what would you do when it falls even further? What if it hits $9 or $8 or even $7? This is precisely the issue that Peter Lynch warns investors about. Many people buy stocks without truly understanding what they are investing in. Then, when prices drop, panic sets in because they never had a solid reason for buying in the first place. They sell out of fear rather than strategy, often missing out on long-term gains. As mentioned earlier, Peter Lynch, the former mutual fund manager of the Fidelity Magellan Fund, has an undeniable track record of success. Now, he's sharing a critical lesson with us, one that could make the difference between wealth and failure in the stock market. Lynch emphasizes that understanding history is crucial. If the market crashes, it's nothing new. In fact, history shows that it happens regularly. The numbers don't lie. Over the past 93 years, the market has experienced 50 drops of 10% or more. On average, a 10% decline happens every 2 years, a pattern known as a correction. But what about bear markets? To qualify as a bear market, the decline must reach at least 25%. History tells us that this has happened 15 times in the last 93 years. In other words, a bear market occurs roughly once every 6 years. This is the cycle investors must prepare for. Market crashes are inevitable. If you can't handle the ups and downs, then the stock market isn't for you. But if you take the time to understand the fundamentals of a company, analyzing its financial health, its competitive position, and its future prospects, you'll see that market downturns are actually opportunities rather than disasters. Let's take a real example. No one can predict exactly how far a stock will fall. Consider what happened with Polaroid. At one point, the stock fell from $130 to $100. Many investors jumped in, convinced that it was a bargain. Their reasoning? The stock had been at $135 not too long ago, so anything under $100 seemed like a steal. But this logic was flawed. Just because a stock was once at a higher price doesn't mean it can't fall further. Peter Lynch himself faced this exact lesson early in his career when he invested in Kaiser Industries. The stock had fallen from $26 to $16, and Lynch thought, how much lower can it go? He decided to buy a significant block of shares at $14, thinking he was getting a bargain. Then the price fell to $10. He called his mother and said, "Mom, you have to look at this." It dropped from $26 to $10. This is an incredible deal, but the stock kept falling. It hit $6, then $5, then $4, and eventually $3. That's when he realized something was seriously wrong. What made this situation so strange was that Kaiser Industries was not a failing company. It owned 40% of Kaiser Steel, 40% of Kaiser Aluminum, 32% of Kaiser Cement, 40% of Kaiser Broadcasting, and 100% of Kaiser Chemicals. With no debt and assets worth $75 million, it should have been nearly impossible for the company to go bankrupt. And yet, investors were dumping shares. Lynch eventually understood that the stock market doesn't always behave rationally in the short term. The key lesson? Just because a stock has fallen doesn't mean it's automatically a great buy. You must understand the fundamentals. People lose money in the stock market because they sell out of fear. They panic when prices drop without a clear strategy in place. This is why it's essential to be prepared for market volatility. If you invest blindly, you will lose. But if you study companies carefully, downturns can present golden opportunities. Peter Lynch believes that financial market volatility is actually a great thing. He recalls a time in 1972 when the stock market experienced a sharp decline, and Taco Bell's stock dropped from $14 to just $1. Despite this dramatic drop, the company had no debt and not a single restaurant had closed. Lynch started buying shares when the price hit $7, and he held on to them. In 1978, Taco Bell became the largest holding in the Magellan Fund before being acquired by PepsiCo for $42 per share. Human nature hasn't changed in the last 25,000 years, and it won't change anytime soon. People will always react emotionally to market swings, causing prices to fluctuate wildly. But for investors who remain disciplined and understand what they own, these fluctuations present immense opportunities. Historically, corporate profits have doubled about every 9 years. Based on this trend, Lynch expects the stock market to double every 9 years as well. This means that even after downturns, long-term investors who stay the course can see substantial gains. His prediction? If profits continue to grow at an 8% annual rate, the stock market should double within the next 8 or 9 years, and then double again in the following 8 or 9 years. Reflecting on his own experiences, Lynch recalls October 1987, a month that shook the stock market. He was convinced that everything was fine and had no worries at all. He and his wife, Karen, planned an incredible golf trip to Ireland, intending to use their savings for a down payment on a house. But just as they left, the stock market plummeted by 55 points in a single day, and everything changed. During his 13 years managing the Magellan Fund, the market declined 9 times, and each time, Magellan's value dropped with it. Yet, over the long run, Magellan continued to rise. Short-term declines are unavoidable, but they don't dictate long-term success. Lynch's lesson is clear. Volatility is not the enemy. Panic is. The key to successful investing is preparation, patience, and knowledge. Market crashes will happen, corrections will occur, and stocks will fall. But for those who understand what they own, these downturns are opportunities to build wealth rather than reasons to run. If you found value in this insight from Peter Lynch, leave a like, and if you're new, subscribe to the channel. Thank you for watching, and we'll see you in the next video.